Today I'm joined by Mark Barnett, fund manager from the Tellworth UK Income Growth. We're going to be talking about what's in his portfolio and some of the decisions he's been making. So Mark, there's mixed feelings about ESG at the moment. Some investors don't want any exposure to companies involved in certain industries, but there are others who aren't that fussed as long as their investments are simply making their money. Now, you've got Shell, Glencore, Imperial Brands and BAE Systems in your portfolio. So it's pretty obvious which side of the fence you're on. What's the reason for holding such names like this?
Well, Tellworth as a fund house has set its stall out to be ESG conscious, not ESG focused. That means we don't exclude industries or companies just because of ESG. Actually, we feel and have felt for a long time that the right way of approaching ESG is engagement, active engagement with businesses that we are owners of, and if we're particularly in the small and medium-sized area where we can have some influence in how the board make decisions and what goes on, where we're bigger holders of those businesses. So ESG, we're not ignoring it, but we think that actually the transition from, if you like, brown to green, particularly in the case of mining and oil and defence companies, the transition process is actually a very profitable one. And what we have seen, and increasingly are seeing, is that these businesses that were deemed to be sort of ESG sinners are now moving quite a long way to make their businesses more transparent, more compliant, more sustainable. And that's only because shareholders have encouraged and cajoled and engaged with them in order to do that. So we think that's the right way to approach this, rather than just saying no defence companies, no tobacco, no commodities.
Now, more than a quarter of your portfolio is in UK retail. Names like Next and Dunelm. The UK economy is arguably holding up better than expected. So are you betting on their earnings being much better than the market's currently forecasting?
The short answer is yes. The longer answer is the market has become, or should I say had become, quite one-dimensional with regard to the UK economy. The kind of thought processes that became commonplace last year were high inflation equals high interest rates equals bad news for the economy, and lots of consumer-facing companies were derated as a result of that. Share prices were falling, creating opportunity because the ratings on many of these companies fell to very attractive levels, and actually that prompted me and colleagues to have another look and think, well, there might be some opportunities here to buy good companies at very attractive prices. And as it's turned out, the UK consumer has held up better than a lot of people had expected, and therefore the trading updates have been more resilient. Not in all cases, but by and large, I'm looking at businesses, I mean, certainly in the case of Dunelm and Next very recently this week, or in the case of the pub companies or Whitbread we've seen today with their trading update. That's largely a UK business that's holding up really, really well. So I think it's important we recognise that there are going to be winners and losers. It's not bad news for everyone. But by the same token, it's very, very conscious of the rating that you're paying for these companies, because the environment is not easy, but the better companies should be able to navigate it. And as long as the rating is appropriate, you can make some money out of the shares.
Now, you recently took a position in Direct Line. Shares are down by about a third this year after a series of setbacks. The dividend's been cancelled, the CEO's been changed. It doesn't really sound like the type of stock that you'd see in an income and growth portfolio. Why do you own this position?
Being clear here, this is a small holding. This is a toe in the water type position, and I'm very conscious that the motor and home insurance market for consumers is fiercely competitive, and has not necessarily been always a good place for investors to look. There are some issues going on at Direct Line, as you mentioned, which has resulted in a big fall in the share price, and prompted a kind of rethink. I think that what we're seeing is are growing nicely, and that's maintained. I think that's partly responsible for some of the inflation figures we saw recently, as insurance premiums still growing quite healthily. Claims inflation has been a problem, but appears to be at least getting no worse, if not getting a bit better. So those are the two dynamics that you want to worry about. Yes, they cancelled the final dividend. They still paid the interim. But again, probably good news if they're trying to rebuild capital ratios, solvency ratios. So actually, the big concern with this one is that they're going to need to raise capital. And so, the fact that they cancelled the final divvy tells me that they're thinking about that, and they're trying to rebuild capital. So certainly not without its issues, this business, but I think they're getting through some of them. And the backdrop, interestingly, at this point in time, looks like it's getting healthier, not worse.
So Mark Barnett from Tellworth UK Income Growth Fund, thank you very much. And thank you for watching.